And this is really the part that when we talk about maxing out your 401k, this is the part that most people aren't aware of and miss. There's this thing out there in the IRS rulebook. It's called 415C limit.
Welcome to Wealth in Progress, the weekly podcast for professionals in their 30s and 40s trying to build wealth while juggling careers, family, rising expenses, and the occasional panic after scrolling social media for 5 minutes. I'm PJ, founder of Wealth and Plan, a virtual financial planning practice serving clients nationwide. If you want to learn more or start a conversation, head over to wealthandplan.com. We are currently accepting new clients and would love to get to know you. Here is this week's episode.
What's going on, everybody? Welcome to episode 3 of Wealth in Progress. I'm PJ. I am a financial planner and owner of Wealth and Plan. I work specifically with young professionals in their 30s and 40s. And for this week's episode, I wanted to talk about a topic that gets confused very often, and that is maxing out your 401ks. So when you think of maxing out a 401k, you typically go onto a website that manages your 401k, whether that's directly through your employer, whether that's directly on a 401k administrator website, such as Fidelity, Empower. There's a whole bunch of them out there. And you typically have a percentage or dollar amount that you can set for your contribution. So some people assume that if they just max out that percentage, that means that you're maxing out your 401k. But there's more to it that I'll define here later on in the episode. So the first contribution limit is what's called a employee deferral. So there can be two types of deferrals that you contribute as an individual. First one could be a pre-tax deferral. What that means is the money is taken out of your paycheck. So if you've got it set up to come out every paycheck, whatever the dollar amount that you might be contributing, you don't pay tax on those dollars today. It goes into your 401k plan. It grows for as long as you need it to. And then once you take it out, if you've met all the rules, such as age 59 and a half, then you can take out those contributions and they will be taxed at your ordinary income tax rates. So that's what's called a pre-tax contribution. You don't pay tax on it today, you'll pay tax on it later on. The other type of contribution that you might make, and you might have that option whenever you go online onto your 401k website, is you can do a Roth 401k contribution, assuming that your employer allows it. Roth 401k contribution works a little different, where you pay tax on those dollars that you're contributing today, and it now goes into the Roth 401k piece of it, and that money goes tax-free. And again, as long as you satisfy all the rules, you can take those dollars out, this time tax-free. So really, you might be asking, which one do I do? Do I do pre-tax? Do I do after-tax? The answer is it depends. It depends whether or not you plan on being in a lower tax bracket later on in life. If you are in a higher tax bracket today, then a pre-tax contribution makes more sense to you because you're not paying tax today, but you will pay tax later and you'll be paying a lower income tax. So if looking 20, 30 years into the future, or however far away that you are from retirement, if you believe that you are going to be in a lower tax bracket in retirement, then a pre-tax contribution makes more sense to you today. Roth 401k contribution, on the other hand, is flipped. So if you believe that you are in a lower tax bracket today than you will be in 30 years or however long retirement is, then paying tax on those dollars makes more sense today. So there's really no crystal ball here, right? I know that sometimes I actually get that question quite often, is which one do we do? And we can make an informed decision if we have your full facts and if we're building out an actual financial plan, and we can sort of run projections on how much money you'll have in retirement, how much will you need to live off of. But in terms of just making a blanket statement of which one's better, it truly depends on your situation and really what you want retirement to look like and when. So we've talked about the first source of contributions, and that is the part that you contribute into your 401k plan. This is the part that most people think that just because they've maxed out the little bar on the 401k plan, that's done. We're maxing out our 401k. Boom, check the box, move on to the next strategy. There's more to it though. Second part is your employer match. Mind you, there's nothing really that you can do about it. That is depending on the rules that your employer set in place. Sometimes they will match a certain percentage. For example, the language might be, will match 50% of your contributions up to 6% of your overall salary. That is a way that some 401k plans are set up. Other plans will say, we'll add a certain dollar amount into your plan regardless what you do. That's called a safe harbor contribution. So the second piece that goes into your 401k plan are employer matches. That is essentially, if you have an ability to take advantage of it, take advantage of it. It essentially is free money that your employer is giving you. So that's piece number two. There's a third contribution that your employer might make on your behalf, and that is a profit sharing contribution. That typically is in addition to the match. For example, if some money was going to be set aside for your coworker's match and your coworker left for a different company, and now your company has this pool of funds, they might choose to split that amongst all active employees and give you an additional profit sharing contribution into your plan. Most of what I just talked about from the employer side, which is the match plus the profit sharing contribution, all of these are treated as pre-tax contributions, meaning that you do not pay tax whenever your employer gives you these dollars. They accumulate into your plan, and then you will pay tax on these dollars whenever you have a qualifying event, such as leaving your employer or retiring at age 59 and a half. There's different sort of rules that you've got to satisfy before you can access those dollars. So we've just talked about three things. We've talked about the money that you contribute to the plan, the money that your employer contributes to the plan, and the profit sharing contribution that your employer may or may not add into your plan. There's a fourth part to this. And this is really the part that when we talk about maxing out your 401k, this is the part that most people aren't aware of and miss. There's this thing out there in the IRS rulebook. It's called 415C limit. The 415C limit is essentially a dollar amount that you can put into your 401k plan overall within one calendar year. That limit typically goes up just a little bit as it's written in the law. But for 2026, if you are under the age of 50, that limit is $72,000. In other words, you can add up to $72,000 from the four sources that I just talked about into your 401k plan in 2026. So let's backtrack a little bit and define individual limits. The limit that you can contribute to a 401k plan using either pre-tax or Roth 401k contributions in 2026 is $24,500. That is assuming you are under the age of 50. $24,500 that you can put into the plan. The second part is your employer match. Again, this varies plan to plan, employer to employer. Depending on how generous your employer is, they might add more, some might add less. That's okay. That is the second piece that makes up the overall $72,000 limit. So let's play a game where you work for a very generous employer and they match dollar for dollar contributions that you add into the plan. As we just talked about, the limit that you can contribute is $24,500 under the age of 50. Let's assume that your employer adds another $24,500 into your plan as well, since they match dollar for dollar in this hypothetical example. So right now, for the year, you've added $49,000 into your 401k plan. You might think, well, I maxed out my part, my plan is maxed out. But again, let's go back to the 415C limit, which is $72,000. So how else can we add more dollars into our plan? Well, third piece might be the profit sharing part. In our hypothetical example, let's assume that there is no profit sharing contribution on your behalf. So what we have left, the limit of $72,000 minus $49,000 that's already been added to your plan, the difference is $23,000. Well, you, as an employee, you actually can contribute an additional $23,000 in our example into our plan. How do you do that? If your plan allows it, and there's a big if here, some plans do, some plans don't. This is something that you'd have to check with your HR or with your 401k administrator. If your plan allows it, you can contribute the difference as an after tax contribution to your 401k plan. So you might be asking, PJ, what is the difference between a Roth contribution in my 401k plan? And what is the difference of an after tax contribution to my plan? They are treated similarly in a way that they both can have Roth rules, but the way that they go into the account vary slightly. So, if you do a Roth 401k contribution, that money goes into your plan as a Roth contribution. You have to satisfy the rules to take the dollars out. For example, you have to either leave your employer, you have to attain age 59 and a half, or any other qualifying event to be able to roll those dollars out. An after tax contribution, on the other hand, you can contribute those dollars using after tax contributions, meaning you've already paid tax on those dollars, and you can immediately turn around and roll those dollars into either the Roth 401k part of your plan or into a Roth IRA outside of your 401k plan. And you can typically do that while you're still working. So you don't have to wait until a qualifying event to do that. If your employer allows it, if your plan allows it, you can take those after tax contributions or the $23,000 in our example, contribute it as an after tax contribution to your plan, turn around and roll it over into a Roth IRA. That is what's called a mega backdoor Roth or a super Roth or whatever fancy term that you might hear about online. So you might be asking, why would I even do this? What's the point of this? Well, for one, the Roth IRA contribution limit. Let's forget this first, forget the 401k plan for a second. Let's say you wanted to just contribute to a Roth IRA. Couple of things happen there. One, there's an income threshold. If you make over a certain dollar limit, you might be phased out of making a Roth IRA contribution overall. Another part to that is if you are under the age of 50, the limit in 2026 to contribute to a Roth IRA is $7,500. That's the most that you can put into a Roth IRA if you just did a straight on contribution. So you might be asking, well, you just said that I can add $23,000 and roll it over to a Roth IRA. Exactly. That's what makes this a useful strategy. You can add money to a Roth IRA beyond the limit. And oh, by the way, the after tax contributions going into your 401k plan don't have an income phase out. In other words, you can be making a higher income and take advantage of the after tax contribution, which you can then roll over into a Roth IRA, right? So it's just an additional option for you to get money into a Roth IRA account. In addition, if you do qualify for Roth IRA contributions, if you are under the income threshold, then the limits stack up. In other words, you can do the 401k part. In our example, the $23,000, you can put that after tax into your 401k plan, roll it into a Roth IRA. And if you qualify, you can also do an additional Roth IRA contribution of $7,500 if you are under the age of 50 in 2026. So, all in all, you might be asking, should I do this strategy? Is it for me? And maybe who is it for? And as with anything in finance, the answer is it depends. There are various factors that we use to determine if an after tax contribution to a 401k plan makes sense. For some people, right, it depends on other savings that you have going on in your household. Part of what we do at Wealth and Plan, whenever we do build your financial plan, is we do look at all different buckets that you own and we try to optimize our savings. In addition to that, right, there's more to it depending on what your goals are. If you are at a point in your life where you're just trying to max out retirement savings and you kind of want to sacrifice a little bit of lifestyle, there's a conversation to be had there. But ultimately, it just depends on what you're trying to do, where you're at in life, what your goals are, and ultimately when you are trying to retire and how do we best optimize your retirement savings. So I'll finish with this. If you are unaware, if you can even contribute after-tax dollars in your 401k plan, feel free to ask that question to your HR or 401k administrator. It's good information to have. If you would like to optimize your savings, if this is something you've been thinking about, or if you are at a point in your life where you're trying to get everything in order, get organized, make sure that you make the right financial decisions moving forward, feel free to reach out to me via my website. I've got my email on there, I've got my phone number. You can also text me right through the website. In addition to that, if you've made it this far, please hit the subscribe button. It helps more people see us and hear us out. And hopefully, we're able to help more people by sharing this information. In addition to that, if you are on the go all the time, we do cross post our podcast to Spotify and Apple Podcasts. And if you are wanting just the highlights, we do post them on Instagram and LinkedIn. So feel free to connect with us on those social platforms as well. And other than that, hope you found this episode useful. If you have any questions, feel free to reach out. One thing I will add before we wrap this up, this episode is for educational purposes only. It's not investment advice. Everyone's situation is a little different, so definitely talk to a financial professional before you make any decisions. Thank you, guys.